Welcome back to Yahoo Finance Live, everyone. Tackling inflation is the number one priority for economic policy right now. Our next guest says that the labor market is showing signs the Fed's plan is working. Gargi Chaudhuri, BlackRock Americas iShares investment strategy head, joins us here. Our first guest
in studio.
Yes, in studio, live and living color here. Thanks for joining us this morning.
So excited to be here. This place is amazing. Thank you for having me.
Well, we're excited to have this conversation with you this morning. I mean, looking across some of the policymakers right now, I mean, they are in quite the situation trying to basically empty the quiver, if they can, on the economic headwinds that they're facing right now. And so how are we to see their policy, their plans working at this point in time?
Yeah, I mean, listen, they obviously find themselves in a really hard place. And some of this is certainly out of their control. You know, we've talked about this before, but some of the inflation that we're seeing right now, and that's true of the US, that's true of Europe, is supply driven. It is related to energy prices going up, which is related to the war. And some of it is obviously related to the reopening after the pandemic and the shift towards goods. So many of these factors are actually out of control for the Fed. Having said all of that, inflation obviously is quite politicized right now. We all saw Biden write that op-ed on Wall Street Journal, and they have to show that they're doing something. So these 50 basis point clips of rate hikes that we're going to see, I mean, it makes sense. They have to do that. But like we've said before, and we said again earlier this week, that at some point, they have to actually indicate that they appreciate that their policy is working. And it is. It is working. We are seeing, just looking at mortgage applications this morning, that's coming down. So I think it's too early for them to take that victory lap when inflation is still likely to come in at an 8% headline handle. But I think they should take some, a little bit of comfort that some of it's working already.
Well, as you say, though, there's so much that they can't control, right? They can control what they can control, famously, right? Yes. But to your point, the war, Russia's invasion of Ukraine happening, to your point, sort of all the other exogenous supply chain issues that are going on around the globe. So all things being equal, where are we when it comes to inflation by the end of the year? And then, therefore, where are we with economic growth?
So I'm going to get a little in the weedsy, which I know you guys love, especially when it comes to inflation. So there is the CPI measure, which we know is the famous one that everyone likes to look at. And also that's the one that tips price off of. But then there's the PCE measure, which is the Fed's more preferred measure of inflation. And I think that because of the compositional impacts of the two, there's going to be a divergence between how CPI and how PCE are going to move going forward. So when I look at the end of this year, CPI, which we're obviously going to get later this week, is going to decelerate. And that's something that Brainard told us about. She's looking for that deceleration from today's levels. I think it's possible for us to get to a CPI level, core inflation, so what that doesn't impact food and energy prices. I think it's possible to see that number in the fours, maybe a little bit higher than that, 4.25 or so. Headline will still, obviously, it'll depend a lot on what energy prices are doing. PCE, though, because of the way it's constructed, it has a lesser weight of shelter prices, of home prices, of rental prices. That will actually come down in a more meaningful manner. When you look at the 3-month annualized, that's already running at 4%. And I think that might give the Fed, again, not enough comfort for them to stop easing quite yet, but I think it should give them a little bit of comfort.
None of those folks should be feeling comfortable at this point in time, and I'm paying, $6-7 for some eggs. But look, I like what you wrote earlier this week, and I made a circle on a page about it. The investment backdrop is no longer supportive of stocks. Well, then where do you go?
So, what the rest of that sentence said was that while it's no longer supportive for a broad allocation, we certainly think that there are pockets that you can still allocate towards and pockets that you can allocate away from. So where you go is quality companies that have the pricing power. Where you go is a little bit of a tilt towards defense, so we think minimum volatility. Where you go is front-end bonds. It's still too early to say bonds are back all in because I still think rates do go up a little bit more. But the front end, with what we're pricing in so far between now and sort of the the end of 2023, I think the front end offers a tremendous amount of carry, a tremendous amount of income right now. So that's another area. And we're seeing so much flow with investors that are just looking to step out of cash. There is an alternative right now. There wasn't before, but right now, when you're earning about 3.75 and higher quality credit, IGSB is an example of that, that's awesome. There is an alternative. And, just this morning, we're seeing pension funds funded status moving up 107%. There is going to be a shift towards fixed income, and front end is where some of that is at. And again, quality companies.
Not to cherry pick sentences. I just happen to like that one. I did read the whole note. I promise you I read the whole thing.
I love that. Thank you for reading.
It's interesting, too, because whereas a lot of the conversation had been framed around value versus growth, it feels like we haven't been having that conversation as much more recently, that it's more nuanced than that,
exactly.
I guess.
Yeah.
That said, it sounds like you're staying away from what we would traditionally think of as growth.
I think, again, within growth, people ask me all the time around technology companies and what we should do there. And obviously, you have a regime of higher real rates. I don't know that we're going back to negative real rates anytime soon. We're moving higher, and we've already moved to positive territory in a meaningful fashion. So there are parts of tech, so the more expensive tech, the more unprofitable tech, that could still suffer as rates move higher. But then there is the other quality part of the technology companies. And this is where, looking at industries like semiconductors, which have gotten unfairly punished along with the broader tech sell-off, where I think you can still gravitate towards, obviously, given the secular demand in that space.
I just had to double check to not thank you in the prompter because you were actually here with us for a change show. It's good to see you, Gargi, Chaudhuri, BlackRock Americas, iShares investment strategy. Good to see you. Thanks for coming in. Maybe next time we'll have our live audience. We can clap you on out of the studio.
Lovely.
We can do it ourselves.
Yes.
Thanks for having me.